Most parents think they're stuck. They can save maybe a few $1,000s a year for college, watch it grow slowly, and hope it's enough. But what if I told you there's a legal way that allows your grandparents to gift $15,000 per year, completely tax-free, and that money doesn't even have to go to college? What if you could change the beneficiary anytime, even back to yourself? What if $60,000 a year could flow into an education account with zero taxes, and through one specific loophole, you could actually use it for non-education expenses without the 10% penalty everyone warns about? That's exactly what 529 plans do, and nobody talks about the loopholes embedded inside them. In this video, I'm breaking down the 4 major loopholes that could save your family tens of thousands, the math that shows how $15,000 a year becomes $619,000 tax-free, and the specific strategies millionaires use to legally game this system. If you have kids, grandkids, or you're thinking about grad school, this changes everything. Welcome back to Faceless Millionaire, where we decode the financial systems the wealthy use to build wealth. No face, no courses, no BS, just straight tactics you can implement today. If this video helps you understand how to save on taxes, hit that like button and subscribe. It takes 2 seconds and helps this channel grow. Quick disclaimer, I'm not a tax professional or financial advisor. The strategies in this video are legal tax optimization tools, but everyone's situation is different. Talk to a CPA or tax advisor before implementing any of these. Now let's get into the loopholes. First, what is a 529 plan? It's a tax advantage savings account created by the IRS specifically for education expenses, named after Section 529 of the Internal Revenue Code. Every state has at least one 529 plan. Some have multiple options. It's not just a savings account. It's an investment account where your money grows. You can choose from conservative investments like bonds and stable funds to aggressive stock-heavy funds. The key benefit: your money grows completely tax-free if used for qualified education expenses. No taxes on the gains, ever. Let me show you the difference. Normal investments. If you invest $10,000 and it grows to $15,000, you owe taxes on that $5,000 gain. Usually 15 to 20% capital gains tax equals $750 to $1,000 gone. 529 plan. That same $10,000 grows to $15,000 and you owe $0 in federal taxes on the gain. Example: if you're in a 22% federal tax bracket plus 5% state tax bracket, that $5,000 gain saves you $1,350 in taxes. That's the power. State tax deductions. This is where it gets even more powerful. Different states offer different incentives. New York. Deduct up to $10,000 per beneficiary per year. $20,000 if married filing jointly. Illinois. Deduct up to $20,000 per beneficiary. $40,000 if married. Pennsylvania, California, Texas, Florida, Nevada, Washington, New Jersey. No state income tax or no 529 deduction, but you still get federal tax-free growth, which is the big benefit anyway. Strategy: if you live in a high-tax state like California, New York, or Illinois, this deduction is massive for your bottom line. What counts as a qualified education expense? The list is very broad. Tuition, private K through 12, school, college, grad school, trade school. Room and board, only if the student is enrolled at least half-time. Books and supplies, textbooks, laptops, educational software. Equipment, lab equipment, musical instruments if required for the course. Student loan repayment, up to $35,000 lifetime. This is new as of 2024. K through 12 tuition, up to $35,000 lifetime for private schools. Also new. The key: these are very broad. Most education-related expenses qualify. The annual gift tax exclusion, $15,000 per person, per beneficiary, per year, without triggering gift tax. This is the annual exclusion. It's tax-free gifting, period. If you're married, both spouses can gift. 15,000 times 2 equals 30,000 per year. If you're grandparents, 15,000 times 2 equals 30,000 per year to each grandchild. This resets January 1st every year. You can give the same amount next year. Now let's talk about the strategies most families never learn. These are completely legal, built into the tax code, but almost nobody uses them. Loophole number 1, the grandparent gift strategy. This is the most powerful, and it's completely overlooked. Most families have 4 grandparents: maternal grandmother, maternal grandfather, paternal grandmother, paternal grandfather. Each grandparent can contribute $15,000 per year to their grandchild's 529 per year, tax-free. 4 grandparents times $15,000 equals $60,000 per year, completely legal, no gift tax. Add the parents, mom and dad, each contributing $15,000. That's another $30,000. Total family contribution, $90,000 per year. Over 18 years from birth to college at 7% average returns, $2.47 million, tax-free for education. Now, not every family has 4 grandparents who can contribute $15,000 per year. I get it, but even if just 2 grandparents can contribute $5,000 each, that's an extra $10,000 per year you didn't have. Over 18 years at 7%, that's $237,000 additional dollars. The grandparent gifting strategy also serves as estate planning. Grandparents reduce their taxable estate while helping fund education. Win-win. Loophole number 2, beneficiary changes. This is the flexibility almost nobody knows about. Traditional thinking: I open a 529 for my daughter. It has to stay hers forever. The loophole: you can change the beneficiary anytime, to anyone with 0 taxes or penalties. Who can be the new beneficiary? Siblings, brother, sister, cousins, first cousins, second cousins. Yourself. This is the big one. You can change it back to yourself. Nieces, nephews, in-laws, even unrelated people. Example scenario: you open a 529 for your oldest child. By age 10, she gets a full scholarship. You change the beneficiary to your younger child. 0 taxes, 0 penalties. The grad school angle: you're in your 30s and want to get an MBA. You take the 529 from your nephew who doesn't need it, change the beneficiary to yourself, and use it for grad school. Completely legal. Why it works: the IRS sees it as one tax-free vehicle serving the same purpose: education, regardless of who the beneficiary is. Loophole number 3, Roth conversion, the penalty workaround. Normal rule: take money out for non-qualified expenses equals 10% penalty plus income tax. The loophole: you can convert it to a Roth IRA if conditions are met and avoid the penalty. How it works: roll the 529 funds into a Roth IRA. You pay income tax on the amount, but not the 10% penalty. After 5 years, it's in a Roth, completely tax-free. You can withdraw the funds penalty-free after age 59 and a half. The catch: you can only roll up to $35,000 lifetime, and the 529 must be open for at least 15 years. Example: you have $50,000 sitting in a 529 unused. Your child is done with school. Over the next several years, you can move up to $35,000 into a Roth IRA for them. That money grows tax-free for retirement, no 10% penalty, no taxes on the transfer. This completely changes the risk calculation for 529s. Before, overfunding meant penalties. Now, worst case, unused money becomes retirement savings. Loophole number 4, room and board reimbursement strategy. This one is timing-based and completely legal. Your kid goes to college and lives off campus. You're paying for rent, utilities, groceries. These are qualified education expenses as long as they're enrolled at least half-time. Strategy: pay these expenses directly from your checking account first, not from the 529. Save all receipts. Keep meticulous records. Rent receipts, grocery receipts, utility bills, all dated, all documented. At the end of the semester or year, reimburse yourself from the 529 for those qualified expenses you already paid. Withdraw that amount tax-free and penalty-free. Why does this matter? Your money stayed invested in the 529 for the full semester instead of being withdrawn monthly. More time in the market equals more growth. If $15,000 per year sits in the account for 8 more years At 7% growth, instead of being withdrawn immediately, you gain an extra 20,000 plus in tax-free growth. It's a small optimization, but over 4 years of college, it adds up. Critical. Keep those receipts. If the IRS ever questions a withdrawal, you need documentation that it was for qualified expenses. 3 years minimum. 7 years is safer. Let's run the actual numbers. This is where the power of starting early becomes crystal clear. Scenario 1. Single child, started at birth. You start contributing to a 529 the year your child is born. $15,000 per year. That's about $1,250 per month. Assumptions. 7% average annual return. This is conservative for a stock-based 529 portfolio. Year 1, you contribute $15,000. At 7%, it grows to $16,050 by year 2. After 5 years, you've contributed $75,000. Balance, $86,600. Gains, $11,600. After 10 years, contributed $150,000. Balance, $207,000. Gains, $57,000. Notice the gains are accelerating. That's compound growth. Your gains are earning gains. Age 18, ready for college. Total contributed $270,000. Account balance $619,242. Your contributions $270,000. Growth from compounding $349,000. The growth is larger than everything you put in, and it's all tax-free. This covers 4 years at a private university, currently about $70,000 per year, so $280,000 total. Plus grad school. Now let's run the multiple grandparents scenario. This is where it gets really powerful. 4 grandparents. Each contributes $15,000 per year. Total $60,000 per year. Same time frame. Birth to age 18. Same 7% return. Total contributions $1.08 million. Account balance at age 18 $2.477 million. Tax-free. That covers 4 years at the most expensive private universities, plus graduate school, medical school, law school, MBA, plus professional certifications, gap year travel, internships, and still leaves over $2 million for other family members or Roth conversion. Scenario 3, the later start. What if you don't start at birth? Starting age, 10. Years until college, 8. Annual contribution, $30,000. Growth rate, 7%. Total at age 18, $308,654. Covers 2 to 4 years of in-state or community college. The point, even starting late, the compounding is significant. Scenario 4, the long game with state tax deduction, annual contribution, $15,000. State income tax deduction, worth $5,250 per year at a 35% combined federal plus state tax bracket. Years 18. Effective annual cost to the family, $9,750 instead of $15,000. Total actual out-of-pocket deposits, $175,500. Tax-free growth, $349,000. Total account value, $619,000. Real return on investment, 43% higher than if there were no tax benefits. That's the power of using state deductions if your state offers them. Now let's talk about strategic implementations, ways to maximize 529s beyond the obvious. Strategy number 1, oldest child first, then beneficiary switch. Fund the oldest child aggressively for ages 0 to 5. $75,000 from grandparents via 5-year gift aggregation. By age 6, the account is growing on its own. Reduce annual contributions. When the second child is born, you have 2 options. Start a separate 529 for the second child with grandparents contributing again, or change some beneficiaries from the first child to the second child. Flexibility. If the first child gets a scholarship, you've already shifted funds to the second child. The money waterfalls down as needed. Strategy number 2, trade schools and career certifications. 529 funds qualify for trade school, plumbing, HVAC, electrician programs, often 2 years, $30,000 to $50,000 total. Covers tuition, books, tools, certifications. Many families overlook this. The funds don't have to go to a four-year university. A trade school graduate can earn $50,000 to $80,000 by age 22, with less debt than a four-year degree. Strategy number 3, K through 12 private school. 529s now allow up to $35,000 lifetime for K through 12 private school tuition. Not per year, lifetime. Should you use 529 funds for K through 12 or save it all for college? Depends on your savings rate and time horizon. Example, $100,000 529 account. Years 5 through 12. Use $35,000 for private school. Remaining $65,000 grows for 6 more years. At age 18, $65,000 times 1.07 to the 6th power, approximately $97,000 for college. Strategy number 4, student loan payoff. New as of 2024. You can withdraw up to $35,000 lifetime from a 529 to pay back student loans, parent or student loans. Tax-free withdrawal. Strategy: if your child finishes college with $25,000 in loans, use 529 funds to pay it down. Reduces monthly payments and interest charges. Strategy number 5, front-loading contributions using 5-year aggregation. Normally, give $15,000 per year. The loophole: you can front-load 5 years at once equals $75,000 per person. 5 years times $15,000 equals $75,000 doesn't trigger gift tax or future reporting. Grandparents example: grandmother gifts $75,000, 5 years worth, to grandchild's 529. Same for grandfather equals $150,000 immediately. That money starts compounding right away instead of trickling in. Child is born. You front-load $75,000 immediately. At 7% for 18 years, that $75,000 becomes $240,000. If you spread it out over 5 years instead, you'd end up with about $195,000. The difference? $45,000, just from timing. Catch: you can't gift more after the 5-year front load until those 5 years pass. You've used up your gift allowance, so front loading locks you in. State tax deductions vary dramatically. Some states offer huge deductions, some offer nothing. Most generous states: Illinois, up to $20,000 per year deduction, $40,000 if married. New York, up to $10,000 per year. Example: Illinois resident contributes $20,000 to a 529. State income tax rate is 5%. Tax savings: $20,000 times 0.05 equals $1,000 per year. That's a 5% guaranteed return before any investment growth. Free money. States with no state income tax or no 529 deduction: California, Texas, Florida, Pennsylvania, Nevada, Washington, New Jersey. If you live here, you don't get state tax benefits, but you still get federal tax-free growth. Important: most states only give you the deduction if you contribute to your own state's 529 plan. Investing in another state's plan usually means no state tax deduction. Recapture provisions. This is critical if you're thinking about moving states. Problem: you move from Illinois, high deduction state, to Texas, no state income tax. Question: do you have to pay back the Illinois state tax deduction? Answer: depends on the state. Illinois: no recapture, you keep the deduction, no clawback. New York: recapture applies. If you move and don't use the funds for New York residents' education, you owe back taxes plus interest. Connecticut: recapture applies. Most states, no recapture. Strategy: check your state's 529 plan rules before moving. If recapture applies, prioritize withdrawing funds for education before relocating. Choosing the right plan. Don't assume your home state plan is best. Some states offer better investment options if you use out-of-state plans. Example: Utah has one of the cheapest, most flexible 529 plans. Nevada is also competitive. If your state has high fees or limited investment choices, you can use another state's plan. Catch: you'll lose the state tax deduction if your state only offers it for in-state plans. Check first. Run the math. If your state gives a $2,000 annual deduction, that might be worth staying in state even if fees are slightly higher. That's the 529 playbook. 4 loopholes, 1 math formula, endless flexibility. 15,000 per year becomes 619,000 tax-free. 4 grandparents, 2.47 million. If you have family members willing to gift, this could save you 6 figures in taxes. Drop a comment if you're opening a 529 this year, and let me know which loophole surprised you most. Subscribe for more tax optimization strategies that actually work. Thanks for watching. Faceless Millionaire. Full disclaimer, all content on this channel is for educational and entertainment purposes only and should not be considered financial, investment, tax, or legal advice. I am not a licensed financial advisor, tax professional, or attorney. The strategies discussed may not be suitable for your individual situation. 529 plan rules vary by state and are subject to change. Tax benefits depend on your state's specific rules and your individual tax situation. The 7% growth rate is an example and not guaranteed. Actual returns will vary. Gift tax exclusion amounts and contribution limits may change with tax law updates. The student loan payoff limit and K-12 tuition limits referenced are current as of 2024 and may change. Front-loading contributions requires IRS Form 709 filing and affects your lifetime gift tax exemption. Beneficiary changes, Roth conversions, and reimbursement strategies have specific IRS requirements. Always do your own research and consult with qualified professionals, including a financial advisor, tax professional, CPA, and education planning specialist before making any decisions. Individual results may vary. If this helped you understand 529 strategies, smash that like button. Subscribe to Faceless Millionaire for more no BS wealth building tactics. Drop a comment with which loophole you're using. See you in the next one.